Hey guys, so I wanted to go over some basic accounting stuff with you and basically just allow us all to understand finances a little bit better within the company and especially within the management team. We're going to be doing probably a few of these lessons so that we each understand our role a little bit better within the company and within the departments. So in order to do that, we have to look at accounting methods, which, let's face it, for most people is pretty boring. However, it's also pretty imperative. Uh, According to Warren Buffett, the language of any business is accounting. So we better know at least a little bit as opposed to knowing nothing. So first thing we need to know is what are we actually looking at in the accounting statements? Most people look at it, or maybe don't look at it, and if they do, they have no idea what they're looking at. And the analogy I like to use is it's a bit like flying an airplane. There's a billion dials out there that we can use, but it doesn't help us much if we don't know what they do. So let's say the business is an airplane and we're flying along. Um, Everything's fine, or it seems to be going fine, and then all of a sudden things are out of control. We were fine. Now we start going down, and we look at our dials and we say we don't know what to do, so we just start throwing levers, and the airplane goes up, it goes sideways, it's everywhere because we have no idea what lever is doing what, and inevitably we will eventually hit bottom and crash and die, and we don't want that. What's important for us is that we are finding a way to read our dials and make sure that we're on a course that's straight and true, and we actually know what it is that we're doing, at least enough to maintain the business. The next few lessons, we're going to look at what will actually help us grow, help us gain elevation. But at this point, we're just looking at what do we need to keep things going. Um, so when you first get into the accounting cockpit, you're going to look and see and realize that there's a billion things to look at and take care of, and to be honest, it's overwhelming. And so for that reason, we're just going to start with the first three. There's three main dials. There's lots of other little dials and statements and references that we can look at, but we're going to look at the first three. And that's in an effort to make sure that we don't hit the mountain. Hitting the mountain, I mean, in business terms, that's called bankruptcy. And bankruptcy, it's a shitty situation because not only does it mean that you're out of money, but it means that there's a big setback in time. And if there's a setback in time, that means that you, instead of starting off um, at a point and leveling up along the way, you level up, you hit bankruptcy, and then you have to start all over again. So you don't just start flying from where you left off, you actually have to rebuild your airplane, which takes a ton of time. Um, and we don't want that to happen. So we're going to go to looking at three main dials, three main charts that we use in accounting so that we all have a basic understanding of where we're at. I'm going to try to make that as simple as I can. So this is the first dial that we're using. It's a box. It looks like this. On the one side, we've got things and stuff. These are all everything we have in the business, things and stuff. And on the other side, we've got things that we owe and things that we own. And the things we owe and the things that we own will equal things and stuff. So for instance, if let's say we have 6 things that we owe on and 4 things that we own, that equals 10 things and stuff. So this is what our business has or owns. In other terms, so 10 is equal to 6 plus 4. In accounting terms, we're looking at A equals L plus E, and A is assets, and L plus E is liabilities and equity. And this dial is what we call the balance sheet. As you can tell, obviously, it balances out our assets versus our liability and our equity. Liabilities, again, are things that we owe, and equity are things that we own. Balance sheet is a snapshot in time. So what that means is it's a picture. It's a snapshot of what's happening at an exact period in time. So as of, let's say, for instance, January 30th, 2016, this is what our balance sheet would look like. All right, let's move on to the second dial. So the second dial looks like this. The box is a little bit different. We've just got one bar here along the bottom, and then this whole section up top. So the section up top, we're going to put money from the customer, and that's what we're getting from the customer for our service. Then we take away the money it took to make the product. So obviously, unless we're doing an info product, that might be the only exception. Everything else, it takes money to make a product. Even an info product, you could argue there's definitely expenses involved with marketing and such as well. So there's always money involved to make the product that you're making. And when you take the money that you have from the customer and you take away the money that it took to make that product, you have money left over. And in accounting terms, revenue is the money that you're getting from the customer. The money that you're taking away to make the product, or all the expenses that it took to make the product. And revenue minus the expenses is equal to your profit. Problem here is that everyone looks at profit, and if they're making profit, then they think everything's great. However, that skips over a few key points. So I'm going to give you one example here. Let's say that we have $10 from the customer. It took us $6 to make the product, and that means we have $4 left over. So we're thinking, great, we got money left over. However, there's another example here where we're getting $1,000 from the customer. We're paying $996 to actually give him the product, to make the product and serve it to him, which means we're also only getting $4 here. Now, all you're going to see when you look at this is the $4. If you're only seeing $4, it doesn't tell you whether you're doing a great job with everything else. You just see that you're making money. Clearly, there's a difference between this business and this business. And that difference is what we're calling the margin. So if you're selling something for $10 and you are spending $6 to make it, and you have $4 left over, that's a margin of 40%. If you're selling something for $1,000 and you're spending $996 to make it, that's a margin of 0.4%, which is considerably lower. And what we're looking at is a high profit margin. And there's different kinds of margins, which we won't get into in this video. We're going to get into a little bit later. But for now, it's important to know that there is margin basically on the product or service that we're selling. Now, this dial is called a profit and loss statement. There's other names for it, but we're going to call it a profit and loss statement, P&L statement. For simplicity, we're going to keep the terms the same. In accounting, there's a lot of terms that are used interchangeably, and for now, we're just going to call them one thing. So for this statement, it's not a snapshot. It's not one point in time. It's more like a movie. So it's more a period of time. So for instance, this would be from January 1st to 30th. So often your profit and loss statement is going to be monthly. And in our case, we're going to be looking at them weekly. So we have weekly profit and loss statements. The other important thing to note is that this is really a theory. Everyone looks at this number and says, that's great, I've got profit. That means I have money to spend. And that's not necessarily true. And I'm going to tell you why with the next statement here. But if we actually have profit, that doesn't mean that we are we're out of the frying pan yet, I guess you can say. There's a lot of other things that are not accounted for within the profit and loss statement. And when I say it's a theory, in terms of like the airplane analogy, really this is only telling us our miles per gallon for the period. So it's only telling us how we did for this period. It doesn't tell us how we did overall for the year, and it doesn't actually tell us overall how the entire airplane is functioning or how the entire business is functioning. It just tells us how much gas we're getting. All right, so the third dial, it looks like this, broken into three parts. First part is going to address all the money that we're getting from the customers. It's going to address the money to make that product. And it's going to address things like money that we paid for taxes during that period. There's a few other things in this section, and it's going to give us our net operating cash flow. So this is our operational cash flow, and it can be similar to the profit and loss statement, but there might be other things within this that are not accounted for in the profit and loss statement. So this is our operating cash flow. The next section deals with all kinds of our investments. So some things are considered investments in accounting. That would be labeled under this section. So let's say it could be actual investments, funds that were invested in there gain us interest. It could be assets. So let's say, for instance, we purchased a computer, or let's say we have an old computer that's a few years old, and we need a new computer to continue business. So we're going to sell that old computer, and we'll record that sale as income. But then we also have to purchase the new computer, and the new computer is probably going to be considerably more than the old computer. So it's definitely foreseeable that you might be in the negative in this column. And this is our investing income, and it records our investing cash flow. In the last section, it deals with our money borrowed to run the business if we need money to create the product and we haven't got the money to do that. And then at some point, if we borrow money, that means we have to actually pay it back as well. So this section is our financing cash flow, and this is the financing part of this dial. If you add all these things up, our operating cash flow, our investing cash flow, and our financing cash flow, it's going to give you what the business has. It's going to basically tell you everything the business has at this point in time. So this sheet is called a cash flow statement. Usually a cash flow statement will also operate like a movie. It doesn't have to operate necessarily within the exact same time frame as the profit and loss, although often it will. And you're going to have a cash flow statement month over month and year over year, and you'll have an idea of the cash coming into. So it'll be the cash coming in and the cash going out of the business. So it's what you've got during this period of time. All right, so now, the other key point to keep in mind is that the cash flow statement, it only shows what's in the business. It won't show us if we have payments made on credit or if we have any outstanding loans. That won't necessarily show up in the cash flow statement. All right, so how do these three things all tie together? So what we've got here is we've got our balance sheet, we've got our P&L statement, our profit and loss statement, and we've got our cash flow statement. Now, if you remember, our profit and loss statement will show us profit. Profit goes to our balance sheet. It goes right here. So this number, our profit, is the same number that goes in here, and this is in our assets column. This number from our cash flow statement, this is everything that we have. So let's go back to that for a second. What the business has, this is considered equity. So this will be everything that we have in the company. This is our equity. And when you have your equity, and you know what your profits are, what your assets are, then you can take those two things and see what your losses are and what you owe thing on. All right, so let's go into the job of a business. So what a business actually is supposed to do. So we're gonna tie this together a little bit more, but in a way that doesn't necessarily use the dials. So what's a business's job? First thing, they're going to purchase assets. Then those assets, they need to be converted from assets into sales. Those sales need to be converted from sales into profits, and the profits need to be converted from profits into cash. And the key here is that so you don't stop at profits. I mean, this is part of the problem. People usually go to profits and then stop there and say they'll call it a day, and that's where the danger lies, and that's where you can get into trouble. So instead of just looking at the profits, we have to look at the bigger picture and make sure we're actually converting those profits into cash, and not just any kind of cash. We're looking at converting it into operating cash, and that's what we can actually use within the business, and it shows us whether we're doing well or whether we're not doing well. So that's a business's job. Now, what about management's job? So in Sidekicks business model, we have what we're calling a trad department, which used to be our HR department. And trad stands for talent, recruitment, and development. So within trad, the recruiting department, their job is to obtain the assets. That means they're actually recruiting the VAs. They're finding high quality assets that we can start working with. Then the development part of trad, so that would be our nesting bay and coaching from there on, is converting our assets into a product, into a usable product. So we're taking something that we can actually sell to a customer, in our case, more rent to a customer. Sales department, they need to find the customers that actually want that product and sell it to them. So now we have a finished product. Now we have to go find who wants that product and make sure that they're paying us for it. Operations, they're the ones that make sure everything runs smoothly. They're basically a quality control of sorts as well. And they're making sure that the customers are happy and they continue paying. Then we've got finance that collects and records the money that the customers are giving us, collects the profits, and they record all the finances that are going on. And then finally, it's the owner's job to try and make sure that they're more assets than liabilities. So the owner's not only looking at profits, but he's looking at all the operating cash flows as well as any liabilities that we have, and in a sense, debts that we have, and making sure that the business is healthy from that standpoint. So this is what it looks like for the managerial departments, and this is on a basic level. In the next few videos, we're going to go into what that looks like in a more complex way, but I think this is all I need to show you guys for today. So if you have an idea, going back through what our 3 dials are, what they stand for, what they look like, and what your basic job is, then that's all we need to look at for now. And then we can we'll go over some of our personal statements, or not our business statements, and I'll show you what that looks like in reality. All right, thanks for watching.